While markets were fixated on rate cuts, election cycles, and the latest AI earnings narrative, something far more structural shifted in the background. It didn't come with a press conference. It didn't move the S&P 500 in a single session. There was no breaking news banner, but it quietly altered the balance of power inside the global financial system. China began reducing its dependence on Western financial plumbing, not with speeches, with flows. Over the last several quarters, Chinese institutions have steadily redirected settlement channels, reserve composition, and trade mechanics away from dollar and euro-centric systems. The most visible signal has been in reserves. U.S. Treasury holdings reported by China have fallen by more than $300 billion from their peak in the early 2010s. But that headline misses the deeper move. The real shift is operational. Energy contracts settled in yuan, bilateral trade lines denominated outside the dollar, gold accumulation through state-linked entities at a pace estimated between 200 and 300 tons per year. Payment rails built that do not pass through Western correspondent banks. One sentence defines the core event. China is building a parallel financial circuit that reduces its exposure to Western liquidity, pricing, and enforcement mechanisms. Most of the crowd misses this because it doesn't look like a crisis. There is no crash, no default, no sudden headline like China dumps treasuries. Instead, it shows up as a slow change in marginal flows, a few percentage points of trade shifting off dollar settlement, a few billion per month not recycled into Western bond markets, a few basis points of structural demand quietly removed. Markets are optimized to react to shocks, not to drift. The forcing mechanism here is not ideology, it is risk management. Over the last decade, access to Western financial infrastructure has become conditional. Sanctions on Russia in 2022 demonstrated that reserves held in foreign jurisdictions can become unusable overnight. From Beijing's perspective, that was not a geopolitical event. It was a balance sheet stress test. Roughly $300 billion of Russian central bank assets were frozen. That number matters because China's foreign reserves are in the $3 trillion range. If even 20% of that is potentially immobilizable under stress, that is a $600 billion vulnerability. So the incentive is simple: reduce single point of failure exposure. What makes this dangerous for Western markets is not what China gains. It's what the system loses. The modern Western financial structure depends on constant foreign recycling of capital. The U.S. runs current account deficits in the $700 billion to $1 trillion per year range. Those dollars must come back as demand for treasuries, agency debt, equities, or corporate bonds. That recycling suppresses yields, stabilizes funding markets, and keeps the cost of capital artificially low. Even small changes in that loop have outsized effects. If 5% of global trade that used to settle in dollars no longer does, that's hundreds of billions in annual dollar flow that no longer needs to be parked in U.S. assets. If reserve managers reallocate even 2 to 3% of their portfolios away from treasuries, that can translate into $200–400 billion of reduced marginal demand in a market where net new issuance often runs $1.52 trillion per year. This is not about collapse, it's about elasticity. Western markets are priced on the assumption that global capital will always show up. That assumption has been invisible for 40 years. It's embedded in term premiums, equity multiples, credit spreads, and fiscal behavior. China's quiet move doesn't break the system today. It exposes how dependent it is on a behavior that is no longer guaranteed. Now here's where it gets dangerous. Markets don't reprice for what might happen. They reprice when the marginal buyer disappears. To understand why this quiet shift matters, you have to see how the modern financial system actually clears and funds itself. At the center is a simple loop. The United States imports more than it exports, by roughly $700 billion to $1 trillion per year. Those dollars accumulate overseas in the hands of exporters, sovereign wealth funds, and central banks. Those entities must do something with the dollars. The default destination is U.S. financial assets, treasuries, agency bonds, corporate debt, and equities. That demand suppresses yields, inflates asset prices, and finances U.S. deficits at low cost. This is not ideological. It is mechanical. Dollars created through trade must be absorbed somewhere. For decades, this recycling has been so reliable that it became invisible. When the U.S. Treasury issues $2 trillion in net new debt in a year, as it did in multiple post-2020 periods, markets assume that global capital will absorb it. When deficits expand during downturns, investors assume foreign demand will stabilize yields. When the Federal Reserve tightens, policymakers assume that international buyers will cushion the shock. That assumption is the weak point, because this system only works if marginal buyers keep showing up. Bond markets don't clear at average demand. They clear at the margin. If annual Treasury issuance is $1.8 trillion and natural domestic demand absorbs $1.5 trillion, the remaining $300 billion must come from somewhere. If it doesn't, yields rise until they force someone to step in. Now consider what China's shift does to that equation. If a growing share of Chinese trade settles in yuan rather than dollars, say moving from 5% to 15% over several years, that could remove $200–400 billion per year from the dollar recycling loop. That doesn't mean selling treasuries. It means not needing to buy them in the first place. Likewise, if China reallocates even 10% of its $3 trillion in reserves away from dollar-denominated assets over a multi-year period, that's a $300 billion structural headwind to U.S. asset demand. Spread over 5 years, that's $60 billion per year. In a market where net issuance is already straining dealer balance sheets, that is not trivial. Here's the key point most people miss. You don't need a crash, you only need the buyer to hesitate. Western financial markets are priced on extremely thin excess demand. A 25–50 basis point move in long-term yields can reprice trillions of dollars in assets. A 1% increase in the term premium on $27 trillion of U.S. government debt implies $270 billion per year in additional interest cost. That flows straight into deficits, which require more issuance, which requires more buyers. That's the feedback loop. Now add a world where a major surplus nation is deliberately building alternatives. Trade that used to generate dollar surpluses no longer does. Reserves that used to default into treasuries are diversified. Settlement that used to clear through Western banks moves onto parallel rails. Sanction risk is treated as a financial variable, not a political one. Nothing breaks on day one. Markets still function. Auctions still clear. But the system becomes more brittle because the elasticity is gone. In the old regime, stress triggered more foreign inflows. In the new regime, stress can trigger withholding, and withholding is enough. This is the part most people miss. Financial dominance is not about control, it's about habit. Once major actors stop treating Western assets as the unquestioned parking lot for surplus capital, pricing models built over 40 years begin to drift off reality. And markets don't correct gradually. They correct when a routine event fails. A weak auction, a spike in funding rates, a widening bid-ask spread, a failed hedge. The mechanism is not collapse, it is repricing under scarcity. Every systemic shift creates winners, but it also creates trapped actors, institutions that cannot simply opt out when conditions change. China's quiet move exposes those traps across Western markets, because the global financial system is built on obligations with deadlines. Debt matures, collateral must be rolled, trade must clear, and when the marginal source of liquidity weakens, the people who rely on constant access to it lose flexibility first. The most exposed actors are not retail investors or even corporations. They are governments, primary dealers, large banks, and leveraged funds that intermediate trillions of dollars in flow. Start with sovereign issuers. The United States is running fiscal deficits in the range of $1.5–2 trillion per year. That is not cyclical. It is structural. Interest expense alone has moved from roughly $350 billion in 2020 to over $900 billion annually in recent estimates. Every 100 basis point increase in average funding cost adds roughly $270 billion per year over time. That money has to be borrowed. This creates a binary constraint. Either demand remains deep and price insensitive, or yields rise until something else breaks. Governments cannot wait for better conditions. Treasury auctions happen on schedule. Bonds mature on schedule. The state must refinance regardless of market tone. If foreign demand becomes less reliable, the system has two choices: attract domestic capital by raising yields, or rely on central banks to absorb supply. Both paths carry consequences: higher borrowing costs or monetary distortion. Now look at the intermediaries. Primary dealers are obligated to underwrite issuance. They must warehouse bonds when auctions are weak. But post-2008 regulations sharply limit balance sheet capacity. Dealer inventories as a share of outstanding treasuries are a fraction of what they were in the 1990s. When foreign buyers hesitate, dealers cannot buffer the shock the way they once could. That's the second trap. Either liquidity expands or volatility becomes the clearing mechanism. Then there are the funds. Pension funds, insurance companies, and risk parity strategies rely on stable correlations and predictable funding markets. Many operate with leverage ratios between 2:1 and 6:1. A 50–75 basis point spike in long-duration yields can trigger margin calls, forced rebalancing, and de-risking. That selling pushes yields higher, which forces more selling. This is not panic, it is arithmetic. Hedge funds running basis trades are even more exposed. These strategies exploit tiny spreads between cash bonds and futures, often levered 10.1 or more. They depend on cheap repo financing and smooth settlement. If repo rates spike or collateral haircuts rise, these trades unwind mechanically. In March 2020, a disorderly unwind forced the Federal Reserve to inject over $1 trillion in liquidity in a matter of days. That was with the old system still intact. Now introduce a world where one of the largest surplus nations is less willing to play the role of stabilizing buyer, not hostile, just selective. The binary choices become clearer. Either auctions clear smoothly, or yields rise fast enough to force domestic substitution. Either funding markets remain frictionless, or leverage unwinds. Either central banks step in, or price becomes the enforcer. There is a historical parallel that matters here. The late 1960s and early 1970s Bretton Woods regime. The U.S. ran persistent deficits. Foreign central banks accumulated dollars and gold claims. Eventually, confidence in convertibility weakened. The system didn't collapse overnight. It strained. Gold outflows increased. European central banks hesitated. Private markets began pricing in devaluation. By 1971, the U.S. faced a binary choice: tighten fiscal policy dramatically or suspend convertibility. Nixon closed the gold window. What's similar today is the structure: a reserve system built on the assumption that surplus nations will absorb deficits indefinitely. What's different is speed. Modern markets clear in milliseconds. Leverage is embedded everywhere. The feedback loops are faster. China is not breaking the system. It is declining to be the shock absorber. That shifts pressure inward. When the marginal buyer becomes conditional, the entire structure of Western finance becomes more sensitive to small changes in flow. A $50 billion shortfall at auction is no longer noise. A 20 basis point move in funding rates is no longer technical. Each becomes a stress signal, and the actors who cannot pause, the Treasury, the dealers, the leveraged intermediaries, are the ones who must respond. Either capital becomes more expensive or stability becomes more artificial. To see why this shift matters, you have to stop thinking in narratives and start thinking in flows. Financial systems don't fail because of opinions. They fail because the numbers stop balancing under stress. Start with the core equation. The United States must fund deficits that now structurally sit between $1.5 and $2.0 trillion per year. Net Treasury issuance in recent cycles has ranged from $1.3 trillion in calmer periods to over $2.5 trillion in stress years. That supply must be absorbed by some combination of domestic savers, institutions, foreign buyers, and central banks. Historically, foreign official and private demand has absorbed between 25% and 40% of net issuance in many years. In some periods, especially when yields were low and growth was stable, that share rose even higher. This external demand is what allowed the U.S. to expand deficits without immediate price pressure. Now build 3 simplified scenarios to understand sensitivity. Scenario A, status quo. Drift. Assume foreign demand falls by only 5% of annual net issuance. If issuance is $2 trillion, that's $100 billion per year that must be absorbed domestically or not absorbed at all. To clear that gap, yields must rise enough to attract new buyers. Empirically, in deep bond markets, attracting $100 billion in marginal demand can require 20-40 basis points in repricing, depending on conditions. On $27 trillion of outstanding federal debt, a 30 basis point upward shift implies roughly $80 billion per year in additional interest expense over time. That worsens deficits, increasing issuance, which increases the gap. The system becomes self-referential. Scenario B, structural reallocation. Assume China and a handful of aligned trade partners reduce dollar recycling by 10-15% over several years. That equates to $200-300 billion per year in reduced marginal demand. Now the market must clear a gap equal to 10-15% of annual issuance. Historically, such a shortfall does not clear smoothly. It clears through volatility. Yields move in jumps. Correlations break. Leverage unwinds. Even a 75 basis point repricing across the curve adds more than $200 billion per year to long-run interest expense. The fiscal math deteriorates faster than growth can offset it. Scenario C, stress regime. Layer in a recession or geopolitical shock. Deficits expand to $2.5-3.0 trillion. Risk aversion rises. Foreign buyers step back, not out of hostility, but out of balance sheet protection. If only 10% of that incremental issuance lacks a natural buyer, that's $250-300 billion that must be cleared through price or policy. This is where central banks historically intervene, but intervention itself becomes inflationary when supply chains are tight and labor markets are constrained. This is why small shifts matter. The Treasury market is enormous, but it is not infinitely elastic. The clearing price is set at the margin. Now look beyond bonds. Equities are priced off discount rates that embed long-term yields plus a risk premium. If the 10-year yield structurally moves from 3% to 4.5%, a stock trading at 20x earnings must either grow faster or reprice lower. A 1-point increase in discount rates can justify a 15-25% compression in fair value multiples. That is not a crash. It is arithmetic. Credit markets are even more sensitive. Corporate borrowing costs are treasury yields plus spreads. When the base rate rises and spreads widen simultaneously, as happens during liquidity stress, the cost of capital can jump 200 to 300 basis points in a single cycle. Highly leveraged firms with EBITDA to interest coverage ratios of 2x or less become unstable. Refinancing walls that looked manageable at 4% coupons become existential at 7%. This is the data story. Western markets are priced for a world where surplus capital automatically shows up. Remove even a fraction of that behavior, and the entire structure becomes yield-sensitive, volatility-prone, and policy-dependent. China's move does not need to win. It only needs to reduce the reliability of the old math. When assumptions change, models fail. And when models fail at scale, price becomes the only truth left. When structural demand weakens, markets rarely respond in a clean, linear way. They don't announce, foreign buyers are less reliable now. Instead, the system expresses stress through micro-failures that look disconnected, until they aren't. The first signal is usually not price, it's friction. Bid-ask spreads widen in places that are normally liquid. Repo rates spike for specific collateral. Treasury auctions clear with thinner cover ratios. Dealers quietly reduce risk. None of this makes headlines, but each is a symptom of a market that no longer trusts that the next buyer will appear on schedule. Then price begins to move, but not smoothly. Yields gap higher on routine data. Equities sell off on good news. Correlations that held for years break. Stocks and bonds fall together. Volatility becomes sticky. The VIX doesn't mean revert. Credit spreads stop compressing on rallies. To observers, this looks irrational. Why are stocks down when inflation is falling? Why are bonds selling off when growth is slowing? Why are safe assets volatile? The answer is structural. Markets are repricing liquidity, not outlook. In a system conditioned to endless absorption, every asset is priced as if exit is guaranteed. When that assumption weakens, investors demand compensation for the possibility of not being able to move size without impact. That compensation shows up as higher yields, wider spreads, and lower multiples. This creates feedback loops. A 30-50 basis point move in long yields reduces the mark-to-market value of bond portfolios by 3-5%. Leveraged holders must de-risk. They sell. That pushes yields higher. Higher yields pressure equities through discount rates. Equity drawdowns reduce risk appetite. Funds reduce gross exposure. Liquidity thins further. None of this requires panic. It requires only rules. Risk parity strategies rebalance mechanically. Volatility targeting funds cut exposure when realized vol rises. Banks reduce balance sheet usage when VAR increases. Hedge funds meet margin calls. Each actor behaves rationally. The system becomes unstable. This is how a quiet shift turns into visible turbulence. The transmission channels are predictable. Gaps in overnight futures as global participants adjust in thin liquidity. Curve steepening when long-term funding becomes scarcer than short-term liquidity. Basis blowouts between cash bonds and futures as balance sheets constrain arbitrage. ETF dislocations where net asset values diverge from underlying holdings during stress. Cross-asset correlation spikes as everything is sold to raise cash. Observers often interpret this as fear. It isn't. It's balance sheet triage. What should be watched are not headlines, but plumbing indicators, treasury auction tail sizes and bid-to-cover ratios, repo market rates relative to policy rates, swap spreads turning negative cross-currency basis, widening credit spreads in high-yield and emerging markets, the dollar's behavior during equity drawdowns, volatility term structure staying inverted. These are signs of a system shifting from abundance to conditionality. Here's the counterintuitive part. Central bank intervention can amplify these dynamics. When markets expect rescue, risk builds. Leverage accumulates. Duration extends. When stress arrives and policy responds, it often does so after damage is visible. The gap between expectation and timing becomes volatility. Each episode trains the system to depend more on policy, which increases fragility. In the old regime, global capital smoothed cycles. In the new regime, cycles are mediated by institutions whose mandates are political, not market-based. That changes behavior. Traders begin to front-run policy. Funds position for volatility, not growth. Corporations hoard cash. Banks ration balance sheet. The economy slows not because of a single shock, but because optionality disappears. This is why reactions may look wrong. Markets are no longer pricing future earnings. They are pricing access to liquidity under stress. China's move does not cause any one of these effects. It changes the background conditions. It turns what used to be rare into what becomes recurrent. And once volatility becomes structural, every asset must be repriced as if exit is uncertain. That is not a crash narrative. It is a regime change. Regime shifts don't arrive as single events. They unfold through sequences. The market rarely wakes up one morning and realizes the system has changed. Instead, it experiences a series of small failures that feel unrelated until a pattern becomes undeniable. So the question is not if this structural shift expresses itself. It's how fast and through which channel. Think in 3 horizons. Next 24 hours to 1 week, you see microsignals. An auction that clears slightly weaker than expected. A funding market that trades a few basis points wide. A volatility spike that does not fully fade. These are dismissed as noise. Next 1 to 3 months, you see persistence. Yields fail to fall on good data. Equity rallies fade faster. Credit spreads refuse to compress. Liquidity thins during normal sessions. Policymakers begin to reference financial conditions more often. Next 1 to 4 quarters, the system chooses a path. Either capital reprices to a higher cost equilibrium, or policy increasingly substitutes for missing elasticity. That is the fork. From here, 3 scenarios dominate. Scenario 1, base case, slow repricing. This is the most likely path. Foreign demand does not vanish. It becomes selective. Marginal buyers demand more compensation. Long-term yields drift higher by 50-100 basis points over a cycle. Volatility becomes elevated but episodic. Equity multiples compress gradually, 10 to 20% over time, without a single dramatic crash. Credit becomes more expensive. Growth slows. The system adapts through price. Indicators confirming this path. Treasury auctions continue to clear, but with slightly weaker bid-to-cover ratios. Long yields trend higher even when inflation moderates. Equity markets rotate rather than collapse. Value over growth, cash flow over duration. Credit spreads widen modestly and remain elevated. Central banks talk about higher neutral rates and structural changes. This is not a crisis. It is a re-rating of the cost of capital. Scenario 2. Stress case. Liquidity break. Here, a shock hits while elasticity is already reduced. It could be a recession, a geopolitical event, or a fiscal accident. Issuance spikes. Risk appetite falls. Foreign and domestic buyers step back simultaneously. Funding markets tighten. Repo rates jump. Basis trades unwind. Volatility spikes across assets. Equities and bonds fall together. The dollar behaves erratically, sometimes rising on stress, sometimes falling on fear of monetization. The system is forced into a binary: let price clear violently or intervene. Indicators confirming this path: failed or heavily tailed treasury auctions, persistent repo market stress, sudden widening in cross-currency basis, rapid credit spread expansion, emergency policy language from central banks. This is the path where plumbing becomes headline news. Scenario 3, relief case, structural offset. This requires a real change in fundamentals. Either fiscal policy becomes meaningfully tighter, reducing issuance, productivity growth accelerates enough to absorb higher rates, or a new global equilibrium emerges where alternative buyers replace the lost marginal flow. This is not impossible, but it requires coordination and discipline that markets do not assume. Indicators confirming this path: sustained deficit reduction, rising real growth without inflation, stable long-term yields despite heavy issuance, renewed foreign accumulation of Western assets. This is the only path that restores the old assumptions. The big picture takeaway is this: modern Western markets are not fragile because of debt alone. They are fragile because they are priced for guaranteed absorption. For 40 years, surplus capital showed up reflexively. That behavior became embedded in every model, mandate, and policy framework. China's quiet move doesn't destroy that system, it removes its invisibility. Once capital becomes conditional, every asset must be priced for uncertainty, not just of earnings, but of exit. Markets shift from abundance to rationing, from smooth cycles to stepped ones, from growth first to liquidity first. This is not about ideology, it is about structure. And structure always wins in the end. This content is for educational purposes only. It is not financial advice. Markets involve risk, uncertainty, and the possibility of loss. Always consult qualified professionals before making financial decisions.